Alrighty, so today we are doing pension and post-retirement benefits. So does everyone know what a pension plan is here that your employer offers? So basically you work for a company for many years, and when you were retired, you get retirement benefits from the company. So we're gonna learn how to calculate, recording all the contributions to these plans, how they're managed, and how they get recorded on financial statements. Okay, we're going to talk about using a pension worksheet. This is going to be the easiest way to learn how to record your journal entries, and these are going to be off components that are going to be off your pension worksheet. We're going to start with the simplest version of a pension worksheet, and then at the end of the class, we're going to get to the hardest one. So it's going to go in steps. We're going to have step 1, step 2, step 3. So we'll start with the easier ones, and then we'll incorporate these, which are going to be the harder components. But you're going to see, I'm going to teach it to you in a way that's very simple. So the learning objectives, using the fundamentals of pension plan accounting, using worksheets for employers' pension plan entries, describing the accounting and amortization of prior service costs, explaining the accounting and amortization of unexpected gains and losses, and then the requirements for reporting the pension plans. So this would just give us an introduction into pension plan accounting. Then we're going to start looking at the worksheet. We're going to go through the most basic part of the worksheet, and then we will incorporate the last 2 sections, which are amortization of prior service costs and unexpected gains and losses. Okay, and then finally we'll look at the financial statement reporting. So we're going to start off by what is a pension plan? A pension plan is an arrangement where an employer provides benefits, which are payments, to retired employees for services they provided in their working years. So usually these plans are not administered by the actual company. The money is put in a pension plan, like a trust company, and they manage the pension plan for them. So the employer just sends it over to these type of companies that manage the pension plans for them. So that's why you'll see that the employer contributes it into an administrator. They administer the plan. When the employee retires, the benefits get paid out by the administrator. You never see an actual employer paying the employee, the retired employee. It goes into a pension plan administrator.
So you pick up on your salary or part of your salary? Or?
So there's going to be different types of pension plans. There's going to be some where the employees actually contribute to their pension plan, and then there's some that's strictly by the employer. So we're going to get to the 2 types of pension plans that there are. So these are the 2 most popular ones, contributory and non-contributory. So in contributory, employees voluntarily make payments to increase their benefits. So for example, my husband years ago was a police officer. He participated in a contributory pension plan, which meant the state funded, but at the same time, him as an employee put additional funding into it. So it increases to get more benefits. In non-contributory, the employer bears the entire cost. So here, it's the employer that contributes all the money that eventually goes to the retired employee. And then you have qualified pension plans, which offer tax benefits. But the 2 main ones we're going to talk about today are these 2. So the 2 most common types of pension plans is going to be the defined contribution plans and the defined benefit plans. On the next slide, I'm going to show you the difference between the 2. We are going to focus mainly today on the accounting for defined benefit plans, because these are the more complex accounting concepts. Defined contribution plans are fairly simple. So what is the difference between the 2? Here you have your defined contribution plan, and here are your bullet points under defined benefit plan. So defined contribution plan, an employee contribution is determined by plan. It's a fixed amount. The risk is borne by the employees. The benefits based on the plan value. And in this case, in defined benefit plan, you have benefits determined by plan. Employee contribution varies, which is determined by actuaries, and I'll explain to you now what an actuary is. And the risk is borne by the employer. So an actuary is a person, this is an actual career that someone does on a day-to-day basis. They run analysis on your employees to determine how much you actually have to pay them in retirement benefits. So they'll calculate based on age, how long they expect you to live, when they expect you to retire, how much is actually needed to to put into this plan so that to make sure you have enough funds to pay out the retired employees. Okay? So you see down here it says makes predictions of mortality rates. So mortality means of when they're gonna die. Employee turnover, interest and earning rates, early retirement, frequencies, future salaries, and any other factors necessary to operate a pension plan. So they look at the plan that this company is running, and they will tell you, you don't have enough money to pay your retired employees, or you do have enough money to pay them. And they analyze these plans every year and go back to the company and say, you need to either fund it more or you will have overfunded.
Is the optional or is mandatory?
These are mandatory. These are all regulated. These plans are regulated by SEC, governments, so you're required to hire these actuaries to do this. Imagine you work all these years, and when you go to retire, there's not enough money in the pension plan to pay out employees.
We do a plan of analysis forward, like
Correct.
future, how
Of
much
course.
is going to variate the salary.
Because there's different ways of running it, because it's based off of future salaries. So they have to estimate what your future salary is going to be, let's say in 30 years, at what age they think you're going to retire at, how long they think you're going to live, so how long do they think they're going to have to pay you out for. They take into consideration interest, because of course this money is being invested, the interest that it's making, what it's earning, to determine that it has enough money in it. Okay? So, there are 3 different alternatives on how to measure the liability of a pension plan. And when I say the liability of a pension plan, it means how much do you have to pay in the future. That's the liability of a pension plan. So there's vested benefit obligation, there's accumulated benefit obligation, and there's projected benefit obligation. FASB requires you to use this one, projected benefit obligation. This is the one we're going to learn today. This is the one we're going to learn how to calculate using the pension worksheet. Okay? And basically, vested benefit obligation is benefits for vested employee at current salary. So it tells you what the obligation is going to be based on today's salaries and employees that are vested. Vested mean that they've already met the number of years needed to receive the benefits. Accumulated benefit obligation is benefits for non-vested employees at current salaries. So you may have just started working at that company, but you're technically not vested in it. So if you leave tomorrow, you don't get the benefits, but they still calculate what the benefits are. This one takes both, but at future salaries. It takes the benefits for vested and non-vested employees at future salaries. So it's the most accurate computation of what the pension plan is going to be in the future, the liability. That's why FASB requires you to use projected benefit obligation. That make sense?
When you have 30 employees and you have a couple of vested, a couple of non-vested, you need to do the calculation based on the 30.
That's correct. That's correct. And every company has a different criteria of what's considered vested and non-vested. Some companies may require you to be there 5 years, some companies may require you to be 10 years. So the best way to think of this, again, like government employees. If you work for a police department, if you work firefighter, they all have pension plans, but they have to work a number of years in order to actually receive the benefits. If you leave beforehand, you don't get the pension plan. Okay? So now we're going to start jumping now into how to calculate these plans. So these plans can either be overfunded or underfunded. So there is a possibility that the plan is overfunded when you put way too much money into the plan than what they believe is needed in the future. In that case, it would be a pension asset, not a pension liability. Okay? Before I jump into this slide, I'm going to start incorporating what the worksheet's going to look like, because I think it's important for you to understand before we actually jump into the components of the actual worksheet. So your pension worksheet is going to look like this. You're going to have your journal entry section. And you're going to have your memo section. on your journal entry side, you're gonna have three components. You're gonna have your pension expense. And this is gonna kind of look like an Excel sheet. When we start working on it, Excel is a great component to use for this worksheet. You're gonna have cash, and you're going to have pension asset or liability. This is a section that's gonna help you compose your journal entries. How you're gonna learn to do your journal entries. This side is just for informational purposes, but you're gonna need in order to figure out, to check your work on your pension asset and liability section. So on the middle record, you're gonna have projected benefit obligation. Plan asset. So let me try to explain to you what's the easiest way for you to understand these two components right here. Plan asset, picture it as your administrator. This is what's sitting on the administrator side. Projected benefit obligation is what you as a business, as a company, is expected to owe in the future to these employees. Okay? So this is pretty much like your bank where the money's sitting, and this is your obligation. And I'm just telling you that because when we start getting to each component, it's gonna help you understand when you move money from one section to the other. When we are gonna be doing each item, this is gonna look like an Excel sheet like this. What I want you to understand is that on every row, you have to have a debit and a credit, like a journal entry. So you must have a plus or a minus on every single row that you do. So you're gonna see when we start getting to these items here, which are gonna be this, you must have it here as a plus and a minus. What we're gonna get to at the bottom is how to record your journal entry. And your journal entry will not balance if you don't have a plus and a minus. Okay? So the most important thing to understand as we start getting through each component now here on this side is where does it actually end up on this worksheet? Where does your plus and your minus end up? Does it come under pension expense? Does it go under cash? Does it go under pension asset liability? That's the most important part. So pension expense, this slide, components of pension expense, you know right off the bat, when we do service costs, it's gonna go under pension expense. This is what it's showing you. Interest on liability is gonna go under pension expense. Then I'm gonna show you where the other side of the entry goes. But for now, whenever you see any of these components, you know it's gonna go right under here, under pension expense. And then we'll show you where the other side goes, okay? This is just going to be now a little description of each component that we just went through, and then we're gonna jump into a problem. So just so you understand, service costs are actuary present values of benefits attributed by the pension benefit formula to employees during service of period. So imagine it as what does it cost the administrator or the company to run this type of plan? That's what a service cost is. We have to pay actuaries, there's a lot of expenses associated with these pension plans. That's what service cost is. What is the effect on the expense? It's going to increase. So service cost increases your pension expense. Interest on the liability. So this is just very simple. What is your interest on your liability do? The problem will give you a certain interest percentage and you're going to calculate it on the liability. The effect on your expenses, it's going to increase it. So interest for the period on the projected benefit obligation outstanding during the period. The interest rate is referred to as settlement rate. So when you see the word settlement rate in our problem, it's interest rate. That's what you're looking for. So sometimes I'll refer to it as interest rate and sometimes I'll refer to it as settlement rate. Okay, actual return on plan assets. So it could either be plus or minus effect on expense. It could either make your expense go up or go down. This is the increase in pension funds from interest, dividends, realized and unrealized change in fair value of the plan. That's why it could be a plus or a minus, because you can have a gain, you can have a loss. Obviously, if the interest is interest income, its interest income increases it. If it's interest expense, it decreases it. So the formula for actual return is your plan asset at the beginning of the year, at the end of the year, minus your plan asset at the beginning of the year, minus contributions, minus benefits paid. Okay? Amortization of prior service costs. This is actually going to increase your pension expense. This means that there was prior service costs that you didn't pick up in your plan in the past, so you have to amortize it going forward. So here it says, plan amendments often include provisions to increase benefits for employee services provided. Companies allocate the cost of prior service costs of providing these retroactive benefits to pension expense in the future. So instead of going back, you're going to amortize it going forward. That's why it's called prior service costs. We're amortizing it. And the last one is gain or losses, and in this case, it could either increase or decrease your pension expense, depending if it's a gain or a loss. So volatility in pension expense can result from sudden and large changes in the fair value of plan assets and by changes in projected benefit obligation. So the money that's put in these administrators and these pension plans, they're invested into the market. That's how they grow. So if the market increases, if you have a gain, it's going to increase your plan. If it goes down, then it's going to decrease the fair value of your plan.
That's why they say the 401k is one of the most,
401k is different than pension. It's similar because it's retirement benefits, but it's not administered as a pension plan. 401k is money that you as an individual take out of your paychecks and you put it into let's say a brokerage account, and it grows tax-free because the gain that it grows stays within there. You don't pay taxes on it. Then you have certain companies that will contribute some to your 401k, but it's different than a pension plan. It's a different type of retirement benefit. Okay. A lot of times employers will not contribute to your 401k unless you contribute, and they cap it out at a certain percentage. Pension plans are usually the employers fund the entire thing. Okay, so we're going to jump now into using the worksheet. So this is what the worksheet is going to look like. Kind of what I was trying to draw over there, but here it's more detailed. So we are going to start, the first three I showed you was annual pension expense, cash, and pension asset and liability. These two are the more complex ones, which we'll get into the second problem when we jump into the other learning objectives. So we're just going to start off with these three right here, and projected benefit obligation and plan asset. Okay, so this right here is a balance sheet account. This is either going to be a pension asset or a pension liability, depending on if it's overfunded or underfunded. Okay, and cash is obviously a balance sheet account, and annual pension expense is a profit and loss account. So we are going to, the items will land here. It would either be a plus or minus going across, and at the end, it will help us draft our journal entry to record the actual asset or liability. And what happens is, the way you check if this is correct, this column right here is correct, your benefit, projected benefit obligation less your plan asset, the difference between these two will either be your pension asset or your pension liability. That makes sense? As we start doing the problem, you're going to see. But the difference between these two will be here. If this equals this, you have no pension asset or liability. Why? Because the value of your actual plan, it equals exactly what they're expecting you to have to pay out to your retired employees. Usually it is, and that's when you need to record if it's an asset or a liability on your balance sheet.
if it's negative, it's a liability.
So if your plan asset has less than your projected benefit obligation, it's a liability. But if your plan asset has more money than what they're projecting, it's a pension asset. Okay? here we're gonna start with the most basics. Again, we're using these three: pension expense, cash, and pension asset and liability. All the problems will be the same way. They will give you different fact patterns, and then you have to determine where it goes on your worksheet to then be able to determine if you have a pension asset or a pension liability, and to record the journal entry on your financial statements. So right here, it tells you at the beginning of the year of January 1st, 2017, our plan assets, so our administrator is holding $100,000. They're projecting our benefit obligation to be 100. So at the beginning of the year, we're perfect. We have on hand exactly what we're needed for our employees when they retire. Then these items are going to take place, and we're going to see where we're going to end up at the end of the year. So we're going to start with I'm just going to write these facts so that when the worksheet opens up, then we can start dropping in the numbers. Okay? So as of 1/1/17, our plan asset had $100,000 in it. And I'm going to start abbreviating this. Our PBO had $100,000. Our annual service costs, $9,000, and if you recall from the last couple slides, that is a component of pension expense. So we already know that that's going to go under our pension expense column. Our settlement rate, which is also known as our interest rate, is 10%, which is also a component of pension expense. Our actual return on plan asset, so actual
increase, no?
yes, we're going to get to that now. It's 10,000. Funding contributions. $8,000, and our benefits paid, $7,000. Okay, and then we're gonna get to the worksheet. And here's what you'll start learning where everything goes on the worksheet, because they will always be the same. So where you see it here on this worksheet, service costs are always going to be a debit to your pension expense, a credit to your projected benefit obligation. So the way we start with the worksheet is we always start with what our balances are at the beginning of the year. So imagine this like a T account, and this is your beginning balance to your T account. So they told you that your projected benefit obligation was $100,000 and your plan asset was $100,000. And you recall I told you there always has to be a debit and a credit. There's your credit and there's your debit. Your plan asset has a debit of $100,000 and your projected benefit obligation, what you have to pay in the future, is $100,000. So service cost is the first one, $9,000. It increases our expense from the side we saw. Increases your expense, debit to service cost. It's going to credit your projected benefit obligation, $9,000. Interest cost is 10%. 10% of your plan asset. Remember that. You're always going to take your settlement rate against this number. And the reason this is important for you to know now as we go into the harder problems is that when we do 3 years of worksheets, this number is going to change every year. Because you're going to start seeing, you see how here we do a worksheet for the next year, you're going to take 10% of this number for the following year. So always remember that your interest cost is the settlement rate of your plan asset. Because think about it, that's the interest that you are making off the money that's sitting in your administrator. That's why it's off of that number. So as it increases, your interest increases. Actual return was $10,000. So it's going to go a credit to your pension expense, and it's going to be a debit to your plan asset. Why? Because it's actual return. It's money that you earned if you're, think of this again like a bank. It's $10,000 you just earned in your bank account. So what is it going to do? It's going to increase your plan asset. So that's why you're debiting it here and crediting over there. Contributions. Contributions is money that the employer put in the plan asset. So they took $8,000 out of their cash and they put it into their bank account, into the plan administrator's bank account, $8,000. That's why this increased by $8,000. Benefits were paid, so $7,000 was taken out of the plan to pay it, and your projected benefit obligation is going to decrease as well. That's why it's a debit. Your liabilities decrease in the debit. So $7,000. Okay? So you see how every debit has a credit when you go across. This is all just a matter of memorizing where things go, because they will always be the same. The only thing that would be different when we start getting to like gains and losses are whether it increases or decreases on your pension expense side. So in this case, if it's a plus, your minus would go on this side, or if it's a minus on this end, your plus would go on this end. Okay? So now we get to the journal entry side. So what you do is you add up every single column here. This number right here, your pension asset or liability, is going to be the number that is needed to make your journal entry balance. So you start adding up all the costs, and when you get to the last one, whatever the number is to get your journal entry to balance, that's how you drop that number in here. And the way you always check yourself is how you check your work. The net of these two numbers should always be here on your pension asset or liability, down here, this number down here. And again, I'm telling you the reason why it's important that you know it's this number is because this, as we start getting into more years of worksheets, this will change. So this number may be one number, I don't know, maybe 5,000, and then you have a different number down here. You always check it by looking at the net of these two numbers has to equal this here. And again, the logic behind it is if your plan asset, in this case, your plan asset has less money than what is needed. So there's a liability, $1,000 liability in your pension plan. And that has to get recorded on your balance sheet. Make sense? Did I lose you? Got it? You're, okay. So if I lose you, just ask me to stop. So now, once you're done with this worksheet, you're ready to prepare your journal entry, and your journal entry comes right off of these figures right here. Okay, so you're going to debit your pension expense by $9,000. You're going to credit your cash by $8,000, and you're going to credit, your pension liability by $1,000. Watch. Yeah. That make sense? Give you a couple minutes to take a look at it, see if you have any questions. Good question. I'm going to put one problem up now, and I'm going to let you guys try to do it yourself. So you can try it out and make sure you feel comfortable. So I'm going to leave this example up here, but I'm going to change the facts over here so that you can try and do your own pension worksheet. So I'll keep this here so you can use it as a guide of how we just did this last problem. So in our example, we think 2018, so let's just change this. So they're saying as of 1/1/18, our plan asset at the beginning of the year was $450. Our projected benefit obligation is $450 as well. So we're right at balance at the beginning of the year. Our annual service cost is going to be $27,000. Our settlement rate is 7%. Our actual return on plan assets is $30,000. Contributions is $32,000. And benefits paid is $17,000. So go ahead and do your own worksheet with those figures. If you get stuck, just let me know, and then I'll start with the solution. But if you think you're on the right roll and you wanna take the answer? Does anyone think they know what the total pension expense would be in our situation, in our scenario? So start from the top. What numbers do you put in the first column as the balance of 1117? Trying to see if I can get this going.
That is like, well, yeah.
Probably, let me see if I have 1, 2, 3, 4.
La diferencia entre estos dos me da
I'm just gonna keep it here anyways, so at least you guys can see where the numbers. So the top, yes, the 450 goes up here as a negative 450 and a positive 450. That's how we start off. Annual service cost, 27,000, goes in your same column. 27,000 and negative 27,000. Your interest cost is 7% of your 100,000, I'm sorry, your 450,000. 31,500. So it's gonna be a debit on your pension expense and it's gonna be a credit on your projected benefit obligation, right? Sorry? Credit. Okay. Then your actual return of 30,000 goes under your pension expense and under your plan asset, $30,000. Then your contributions of 32,000 is going to decrease your cash 32,000 and increase your plan asset 32,000. And then your benefits, 17,000 goes here and negative 17,000. So your first column of pension expense should total 28,500. 28,500. Your cash should be 32,000. Credit. So in order for your journal entry to tie, you have a debit of 28,500, you have a credit of 32,000, you need another debit of 3,500. But in this situation, it's a pension asset. Because if you add up all these columns, and I don't have the sheet in front of me, but you'll have 495,000 of plan asset, and you're gonna have 491,500 of benefit, projected benefit obligation. That means you have more money in your bank than what's expected in the future. So you're overfunded.
No, I'm overfunded, but I have 408,500 in benefit.
Which one?
In the benefit obligation, give me 408,500 instead of the number that
450, 27,000, 31,500,
and 17.
17 as a debit.
Yeah. I don't know, maybe it's just very, those numbers are all negative.
Your 450 is a credit, 27,000 is a credit, 31,500 is a credit, and debit is 17,000.
Yeah, I take 450 minus 27 minus.
No, it's 450 as a negative.
Mhm.
So you're adding these. You're adding 450 plus 27 plus 31,500, and then you're subtracting 17,000. I'm gonna check it with my calculator, but I'm almost positive it's correct.
Well, at least that's what I have.
Yes.
Yeah, but when you do, credit, automatically when you have them, it's counting.
So when you do this in Excel for homework, the good news is that you can just use your formulas. So you'll sum this all up and it will automatically pick up that this is a negative, this is a negative, this is a negative, this is a positive. So it should total it up
That's
correctly.
what I'm telling you.
So your journal entry, which in this case, so from this problem compared to the one we're doing right now, in this problem we did here, we had actually a credit into our pension liability. In this problem we just did right now, we're gonna do a debit to pension asset because we're overfunded. So your journal entry should be a debit to pension expense for 28,500.
And the other was 491,500?
That should be your journal entry. Again, the way we check it with the memo is your plan asset was 495. And your projected benefit obligation was 491,500. We had more money than what we needed in the future, so it's an asset, and the difference is your 3,500.
So your plan asset is 32.
No, your pension asset, this is your balance sheet entry. Remember, this is a balance sheet account. So this is what you're going to record on your balance sheet account, and it's going to be an asset because you're overfunded. Okay. But what I'm trying to explain to you is that that's how you check to make sure that this right here, this side is correct, is by taking the difference of these two, and it checks your journal entry to make sure you did it correctly. Okay? So again, this is the most basic of a pension worksheet. These are the most basic items and the most basic columns. We're gonna now move on to start learning how to work with prior service costs and gains or losses. I wanna make sure you guys understand these basics before we move on. Remember, the critical items to know is that when they do a settlement rate, it's always off of your plan asset figure. So if we're doing multiple years, you're gonna take whatever the beginning balance is of your plan asset and multiply it times that settlement rate. And besides that, this is just the basics of your pension worksheet. So let's move on. So the next learning objective that we're jumping into is amortization of prior service costs. So as I had mentioned before, certain plans can calculate what their prior service costs would have been if there was a change to a plan or a new plan was initiated, and they take that amount and they're going to amortize it over future years. So amortization, companies should not recognize the retroactive benefit as pension expense in the year of amendment. Employers should recognize the pension expense over the remaining service lives of the employees who are expected to benefit from the change in plan. The board, which means FASB, prefers a year of service method. Employers may use a straight line amortization over the average remaining service life of the employees. So these slides are basically just going to explain to you how companies go and calculate how to amortize this prior service cost. But in our problems and the homeworks, the problem will give you that already. You're not going to have to learn how to calculate this. But I just want you to still understand how companies do it so you understand it. So this would be an example. Assume that Zardi Company's defined benefit pension plan covers 170 employees. In its negotiation with the employees, Zardi Company amends its pension plan on January 1st, 2018. So they're amending it, they're making changes to the plan. And grants $80,000 of prior service costs to its employees. So this amendment, now they're gonna give them $80,000 of prior service costs. The employees are grouped according to expected years of retirement. So they expect Group A, a number of employees of 40, they're expected to retire in 2018. Group B, 20 employees in 19. Group C, 40 employees in 20. Group D, 50 in 2021. And E, 20 in 2022. So the total number of employees are the 70 that they're referring to, and these are their expected retirement dates. So this is how they're computing what they call the service years per year. So they take each one from the slide before, and they start allocating them across the groups based on the years. And they come up with a total service hours of 500 by the allocation. So they take all the employees year one, then the following years after that, they take out the 40 from the year before, and so on and so on and so on. So they come up with this 500. They then take the $80,000 that they mentioned in the beginning of the problem of the prior service costs, and they're going to divide it over those 500 hours we just calculated. That's going to come up with $160 cost per service year. They're going to take that cost per service year, they're going to multiply it times the total service years that were computed before, and they're going to come up with their annual amortization. So you see how they're taking that $80,000 and how they're going to amortize it going forward for the next 5 years? That's all they did. Instead of saying, okay, great, we had this $80,000 cost from the past, instead of picking it up in 1 year, they're just showing you how the companies are going to amortize it over the next 5 years. And this is one of the ways they calculate it. But like I said, you don't need to know how to do this for our problems, for our worksheet, because they'll give you these figures already. Okay? So this is the exact same thing we just did a couple slides back, the problems we just practiced on, but now it starts getting a little bit more detailed. So you're going to see new. Let's start off with the fact that now it doesn't balance at the beginning of the year. Remember our previous problem, the both amounts balance. Here they're already starting off on a difference. We are going to have pension liabilities. We're going to have an amendment, settlement rate. Well, we've already done settlement rate, we've done service costs, we've done contributions, we've done actual return on plan assets, we've done benefits, but this is going to be new, and these are going to be new up here. Okay? So I'm going to write the information on this side, just so we have the details, and then we'll start dropping it in. So we have PBO 560. And notice how it says before the amendment, because that's important when we get to the worksheet. Before the amendment. So this is as of 1/1/17, before your plan asset. $546,200. Your pension liability. $13,800. On January 1st, 2017, right of accord through plan amendment grants prior service costs having a present value of $120,000. So the amendment is going to be $120,000. Prior service cost is $120,000. Settlement rate 9%. Service cost $8,000. Contribution $65,000. Actual expected return of plan assets 52,280. Benefits of 40,000. And prior service cost amortization for 2017. Of 17,000. These are all your fact patterns. So we get our worksheet in place, you pull it up in Excel, and you start dropping in the information of the facts that they give you. So we started off, they gave us what before our amendment. So you see how we have a balance on 1/1/17, and then we have a new balance as of 1/1/17 after our prior service cost adjustment. So that's why it's important that they tell you before the amendment. So your PBO is 560, your plan asset is 546,200, and your pension liability is 13,800. We net this across, and it all equals 0. It balances out, correct?
Beautiful, this is before,
Correct. They're giving you this information. They're telling you at the beginning of the year, this was the information you needed to know. This is the relevant information at the beginning of the year, right here, before any amendments were made. Next thing they do is they take the 120,000 amendment. You see the prior service cost amendment of 120? Now we start using these columns right here. This OCI stands for other comprehensive income. Do you remember that from intermediate accounting 1? Other comprehensive income, you guys worked on this. That's where this is gonna end up on your financial statements, under the computation of other comprehensive income. You're gonna have a line item called prior service costs on your financial statements, and that's where these amounts will go. You'll see when we get to the last couple slides on the presentation of financial statements, how all this comes into play. That 120 is now an adjustment to your projected benefit obligation. Here's the other side of your entry, 120. Okay? So now we're gonna have our new balance as of 1/1/17. Why is that important? Because when you go to calculate with your settlement rate, you need to make sure you're using the correct and balance to use that 9%. So we now have 680 in our projected benefit obligation, plan assets 546,200. Service cost, we're going to increase our pension expense 58,000. We're going to credit projected benefit obligation 58,000. I'm just going to follow this up here so I don't have to continue walking back and forth. Sorry. So we went through service cost. Interest cost, 61,200. You're going to take 9% of 680. That will give you 61,200. I'm going to check it on my calculator here just to confirm. 0.09 times
why do
680.
we take that as the 80?
61,200. Sorry, just making sure the number's correct.
The addition to 550 to.
I know, but it wasn't for that.
It's off of your projected benefit obligation,
Why?
because that's the interest rate that you're calculating of what you expect your obligation to be in the future.
Okay.
So remember in the beginning of the slides when we were going through interest rate, it tells you you're trying to figure out if it's the increase or decrease.
The last one you have to take that out.
In the other one, it didn't matter because they were the same number, but it's actually out of your projected benefit obligation, not your plan asset. Okay? So you're gonna take 9% here, it's how you're gonna get to your 61,200. So you see how the 61,200 lands under your projected benefit obligation? Because you're calculating off of this. Asset return, 52,280 comes right off of our facts. So you're gonna decrease your annual pension expense, 52,280, and it's gonna go on your plan asset, 52,280. Amortization of prior service costs. So this is the new component. Here's your 17,000 for amortization. This was that whole calculation we just did in the slide before, how they came up to the amounts to amortize each year. Notice how here they're already giving it to you in your in your facts. So you don't have to come up with that calculation. So it will generally always increase your annual pension expense, and the other side goes under your OCI, your fire service cost, of other comprehensive income of negative 17,000. Contributions we've already done in the past, and benefits paid we've done in the past as well. And does this one make sense to you, the benefits paid, why it goes on these two columns? You're taking 40,000 of actual money that's sitting in your plan administration, you're giving it to your employees, so you decrease your plan asset, and at the same time, you're decreasing your obligation, because you've already paid out 40,000 that you were required to pay out as a liability. So you then go and you start adding across your journal entry, 83,920 minus 65,000 plus 103,000. You are missing, you need for your journal entry to balance a credit of 121,920. How do we check that again? You add up everything in your two columns, and the net difference between the two is 135,720. You recall how I told you it's not this number. When you take the net of the two, it's the one down here, because in this case we have a beginning balance. So 135,720. Here's your 135,720.
Well, first you have the journal that do all the calculation, then you have.
So, because now it's just getting a little bit more complex. So what happens is, these amounts right here, these three are carrying balances. They don't zero out. So you're gonna continue. So if we keep on to the next year, you already know what your beginning balances are. It will be these ending balances. You keep carrying them forward. At the end, the last slide, right before we finish, we're gonna do 3 years in a row, and you're gonna see how it comes into play. So this stands for accumulated other comprehensive income. It's your accumulated OCI. It just happens to be in this situation, this was 0 and this was 0, that's why there's 0 here. But if you had a number here at the beginning balance, it's gonna end up here. Because it's your accumulated other comprehensive income as of the prior year.
But the 135.
The 135 is these two numbers added up together.
Oh, sorry.
No, it's okay. It takes time. Let it sink in.
No, because I was looking this way, I feel like maybe, no, I was thinking it's separate, it's using those values, you do all the calculations.
No. These are your journal entries. These are your memos. And the slides teach it to you in pieces. And at the end, we're going to do one problem that's going to incorporate everything we just done all in one problem. And you'll see how it all flows into it. Because when we start doing 3 years in a row, then you're going to start, you see how here you already have an ending balance. You'll have a number up here, which will then drop into here.
So in the next one, your beginning balance is improved service cost is 103.
Correct.
And pension asset is 135, correct? And in the other one is.
And these will carry on, exactly.
And
These those 4 numbers up here will end up right here.
And then you start.
And then you start the next year.
The 9%,
Correct.
and
Because
then-
we'll get to that problem. We still, I think, have a couple more slides before we get to it. They will give you all this information for 3 years. And they'll say, this is the information from 16, here's the information from 17, here's the information for 18. Prepare 3 years of worksheets. Okay? So they do it like this in bits and pieces so that you understand how everything goes into play. They start off with the easier ones, we're gonna incorporate the hardest stuff. We're now, the next slide, we're gonna learn how to do this one. This is the last piece we're missing, gains and losses. So we've now done annual pension expense, cash. This is a new one we just did now, fire service costs. The last one we're missing is gains and losses.
So when I read the gain and losses, I was almost sleeping. When I was reading, the gain and loss is kind of the same that the pension asset or pension liability, no?
No.
It's,
Gains and losses are when, for example, the value of your plan asset changes, which changes in the volatility of the market, so it creates a gain or loss. So when we start getting now I'm excited the gains or losses, they'll tell you what your asset return is your actual return of asset, and what you were expecting your return of asset to be, and the difference between the two will determine whether there's a gain or loss.
Yeah, but if or
It does take into consideration, yes, and you're gonna see it's gonna affect your pension asset or liability, but it's not the same, they're different. So this is just the journal entry now off of, well, let me just go back here, so remember the journal entry,
OCI, what is it?
other comprehensive income.
Accumulated.
The bottom is accumulated other comprehensive income, but this OCI stands for other comprehensive income. Which again, you learned in intermediate accounting 1. So, your journal entry,
what if you don't have enough space in the Excel when you
the template, does have an Excel, it should. Strange it doesn't. If it doesn't, just create your own Excel, but it should. Email me, if you get stuck on a problem because it doesn't have space, just send me an email.
It's pretty easy because it's what we're doing right now.
Yeah.
Oh, you working on that? What?
It's easier for me to
Oh,
the, like, well, after she explains the
you have to
problem,
give
then
me the
it's
phone.
fine.
So this is the journal entry. So we get the information right off the sheet we just did. There's where your other comprehensive income goes. $103,000 of a debit. Debit your $83,920 to pension expense. Your pension asset, or in this case, a liability of $121,920 and $65,000 of cash. So that's what the worksheet is mostly relevant for. It's helping you drop in all the information so then you can come up with your journal entry. It makes it the easiest way to do your journal entry. Imagine they gave you all that information and then tell you, do a journal entry. You'll never be able to come up with this. You need to drop it all into that worksheet so it's easier for you to follow the information. Okay, do you want a break before we jump into the next section? Water break, bathroom break, anything? Or do you want to just keep going? It's up to you guys. You want to take a 2-minute break, 3-minute break? Okay, break.
Whichever one.